The time has come for our 2024 outlook, and we've got a great one. A dozen charts signal big gains in 2024. Guys, if we rewind the tape back to 2022, coming into 2023, we were very bullish on stocks, very non-consensus call. The world was thinking that it was over, but listen, data has a way of cutting through the noise. Let's get to why we believe 2024 has got some very big gains for stocks. And the first chart we're going to go through is the Goldilocks growth. Okay, we basically have falling inflation, right? That is the core PCE, that is this red line. And this is at odds with the Fed funds rate, right? Fed funds is at 5.5%. But we all know that markets aren't priced on where we are now, it's where we're going. So if inflation is falling, federal funds interest rates, they're going to go lower. The Fed is set to cut rates multiple times in 2024. That bodes well for risk assets, namely equities. Now, one of the biggest bear tales that is being spun right now is that the equity risk premium signals a lot of doom. Basically that because of bond yields, there's no reason to own stocks. But let's go ahead and look at that and see if it actually holds water. So the risk premium right now is 1%. Okay, so the S&P 500 earnings yield is 5.2%. It's this green line right here. And then you got the treasury yield, that's at 4.2%. So you're talking about a 1% equity risk premium. Why are the bears all freaking out about this? Well, they basically are telling you should go buy treasuries. However, if you study history, here's what we know. That whenever the equity risk premium is between 0 and 1%, where it is right now, the 12-month forward performance for the S&P 500 is 12.2%. Now consider that in relation to the average of the S&P 500, it usually gains 9.1%. Bigger gains tend to happen whenever there is a low equity risk premium. So hug a bear because they need to see this chart. Now you may be wondering why. Okay, if the risk premium is so low, why would stocks do well? It's because stocks are not priced on where we are today, it's where we're going. We know interest rates are coming down. That means that the equity risk premium is set to explode higher. Don't play for today, play for tomorrow. Let's get to our next chart. A lot of people, they signal how the narrow market is somehow bearish for the stock market. It's actually not, right? Because what happens whenever the market is narrow? It's telling you that a few leaders are holding the market up. A lot of stocks are sold under the surface. That just represents value, right? Because you want to buy when stocks are low. Here's the cool study. Since 1928, stocks are up 15.4%, 12 months after when you have the lowest breadth readings. Literally what we were seeing in October. That's when we were beating the drum. History backs that up. So again, when you see narrow leadership, you probably want to be buying stocks based on this chart. All right, let's keep going. So here we are. We know that earnings is what drives stock market performance. So a lot of people and the bears, they're talking about earnings, right? They're so low, but here's what they miss. Whenever earnings are accelerating, that is telling you that the macro is getting better. It's getting bloomier rather than gloomier. Earnings, they were negative in June on a year-over-year basis. However, earnings have started to re-accelerate 5.7%. So the consensus forecast is an 11% year-over-year EPS growth. So what does that mean? Check out this chart. Stocks shine in years after bottom quartile EPS growth. All right, so if you go from negative EPS growth to positive EPS growth, that's going to put you in this area over here. That's your worst 12-month estimate growth. But here's the deal. Again, the stock market is up 13% 12 months on average whenever earnings go from negative to positive. The reason, again, let me just say it loud and clear for the bears to hear. When earnings are accelerating, that is when you want to be long stocks, and especially whenever they are starting from a negative point, which is what they had a couple of months ago. So now let's talk about where all the money is. Well, we know what's very popular, right? Look at this chart. Record cash is going into money market rates, okay? You're sitting on roughly $6 trillion that are earning a risk-free yield in money market rates. Okay, if you ever want to see what a crowded trade looks like, this is it. Now, why is this potentially bullish for stocks? Well, here's the deal. When you look after taxes, right, we're talking about the US, that 5% rate is going to drop to about 3 to 3.5%, okay, barely above inflation, which is 3.2%. But again, we told you money markets, those yields, they have peaked, right? The Feds, they're starting to reduce their rates, they are expected to reduce their rates in 2024. But that just means that yields are going to come down. They're going to become less attractive. So here we've got this record cash, right? It's sitting in these risk-free money market rates. Well, here's some things to consider. At 5% after taxes, we're talking about US taxes, it's more like a 3 to 5% yield is what you're gonna really get. And that is barely above CPI, okay? But here is the deal, money market yields, they have peaked. We all know that the market is expecting the Fed is going to start cutting rates multiple times in 2024. And so that is going to make these juicy yields way less attractive. So where do you think some of that money is going to go? What is going to become even more attractive? We believe equities, right? Now, if you consider that the US stock market is worth roughly $50 trillion, if only 44% of that money market money, if $2.5 trillion goes into equities, that's a total of 5% flowing into stocks. Very, very bullish setup. So now let's talk about what this means in terms of institutional positioning. You guys know our favorite barometer for institutional appetite is the big money index, BMI. It has been in a huge uptrend. We've been telling you guys all about it since the lows that it made in October. We are not overbought, so that tells you that money is continuing to pour into stocks. That is another feather in the bull's cap. Here's something else. Consider this. We had our rare oversold big money index. This is back in October. Check out these stats. Every time that we have gone oversold, from the last day, the S&P is up 1% a week later, 5% a month later. 3 months later, you're looking at an average gain of 5.4%. 12 months later, 15.4%. So again, everything is pointing to better days ahead in 2024. I know the crowd doesn't want to hear it, the bears don't want to hear it, but these are just facts. So what are the best sectors to own in 2024? It's not necessarily what you buy that's the most important. It is that you buy. So if you just buy the S&P ETF like VOO, we think you'll do just fine. But consider our top sectors. These are map scores. This updates every single day in our portal. Top score is technology. Second is discretionary. And number 3 is industrial. So those are the areas I want you to be focused on right now. And if we go and we look at history, what do we know about those sectors? Well, if we look at the 2024 S&P 500 consensus EPS forecast, right? This is the year-over-year change. Where is the biggest growth slated to come from? Well, top is healthcare at 19.4%. Comm services, which has a lot of tech in there as well, 16.3% growth. Technology, 15%, and then discretionary at 12.7%. We do like industrials, as we said. Not only does it score well, but it's also offering 9.7% expected EPS growth. So those are the areas to be looking at. But let's also put this together with an oversold BMI. So when we look at all of the oversold instances since 1996, technology and discretionary reign supreme. A year later, technology stocks are up 27%. So we've got a ways to go. Discretionary, it is not too bad. Looking at an 18% gain a year later, in industrials, 15.7%. These are juicy numbers, and this is why you want to be very constructive on stocks heading into 2024. 12 charts, go share it with a bear. Make sure to like and subscribe to our YouTube channel and send us some feedback. We will see you guys next time.
you.